So welcome everyone to the second half of chapter 9. Now, the first thing I'm going to do is just kind of go through a recap of everything that we talked about last week. So we started with discussing long-term liabilities, those liabilities that are due in over a year's time. And one of the first things we talked about is that companies oftentimes will fund expansion with a mixture of capital, which would be selling shares of stock, and financing, which are taking out loans. And the benefit of loans or liabilities is that the interest is deductible. So that is a huge benefit with loans, is that you can write off the interest from the borrowing. And then we started the chapter talking about installment notes. And basically, with an installment note, it's basically where there is a payment that is made per month for a specific number of periods. Oftentimes, car loans are for 4 years, 5 years. Home loans are usually for 30 years. And so there's a flat payment that is made each year. And a portion of that note, that payment, will go to pay principal and will go to pay interest. And so we talked about how we calculate the interest amount. We take the carrying value of the loan and we multiply it times the stated interest rate divided by 12 times a month, or times 1/12, we should say. That is the interest for that month. And the difference between what you paid out and the interest, the difference goes down to paying down the principal of the loan. So we really spent time focusing on an amortization schedule. And then we also understood how to record these journal entries, how to record taking a note out, and then how we record the monthly journal entries for paying the note, along with the corresponding interest and reduction in the note payable. So we went through that, and then we started talking about and we talked about leases too. There's an operating lease and there's a capital lease. Capital leases are basically when you're purchasing an asset, but you're treating it as though it's a lease in purchasing the asset. So, and we also talked about how when you borrow money versus when you just have a true operating lease, how oftentimes when you compare a company that has an operating lease versus someone that has an actual capital lease or purchasing an asset, how the ratios are not as favorable, because even though the assets may increase, your liabilities are increasing in proportion, which can have a negative impact on your debt to equity ratios. So we talked about that. Then the big hit for this week is discussing bonds. So we started talking about bonds and how there are some key pieces here. There is the face amount on a bond. The face amount is just what is shown on the piece of paper that this bond's face is, 100,000. The stated rate that is shown on that bond only is used to figure out the interest payment every 6 months. So when you take the face amount times the stated rate times half a year, because generally bonds are paid semi-annually, twice a year. The stated rate is used to show what the payment is every 6 months, and that is it. And then we talked about the market rate. The market rate is the key. The market rate is what an investor wants to get or expects to receive for an investment. And so when you have that market rate, that's what's used to determine the interest expense. So we talked about a couple different ways of doing it, of when the face amount is the same as the market, the stated rate is the same as the market rate, then bonds are issued at face value. And then we talked about when the market rate is greater than the stated rate, bonds are issued at a discount. And what that means when bonds are issued at a discount, that means is an investor in this bond is going to pay less than the face amount for the bond, because the stated rate, what the amount of interest payments are, is under what the market is willing to bear. And as a result of that, the way it's made up is for paying for this bond lower than the face amount. And so to help make up that extra 8% or that 1% of interest, the issue price is going to be under the face amount. Then we talked about bonds being issued at a premium. This is when the market rate is lower than the stated rate. When that's the case, investors will buy this bond for a premium for over the face amount, because the amount they're receiving every 6 months is greater than what the market is going to bear. So we talked about the different ways of calculating this by using Excel or using the annuity tables. And this is a real key here. Know this. Know that when the bonds are issued at a discount is when the stated interest rate is less than the market rate. Know that when bonds are issued at a premium, the stated rate is greater than the market rate. Let's try this one, guys. We did this last week, but let's try it again. Who can remember this? If a 10-year bond is issued with a stated rate of 9% when the market rate is 8%, are the bonds going to be issued at a discount or a premium?
Is it a premium?
Correct. It is a premium. You're exactly right. Okay. Then we went through some problems just to get a grasp on this information. And we also learned how to go about recording these bonds when they're issued at a face amount, along with the interest payments. But more important is knowing how to record them when they're issued at a discount or when they're issued at a premium. It's just like an installment note where a portion goes to interest. You know the payment amount every 6 months. And that difference between the interest and the payment amount will be offset to either the discount on bonds payable or the premium on bonds payable? So we talked about this amortization schedule. And if a bond is issued at a discount, as in this scenario, the carrying value is the issue price. And the interest is always figured out based on this carrying value times the market rate times half a year. As you see in this example, the cash paid is less than the interest expense. Since the cash paid out is less than the interest expense, we offset it by the discount increasing the carrying value of the loan, of the bond. So in this first example, we know 93,205 times 4% gives us the interest expense of 3728. Since that interest expense is greater than the cash that was paid out or received by the investors, that difference, the 228, is added to the carrying value of the bond. So until maturity, the interest expense will increase every period, and the carrying value will increase every period. So we went through that. And we went through various problems. So before we start with showing the retirement of bonds, I'd like to go over a problem, if that's okay. Okay? So, thanks, Jim, for getting that. So let's look at a problem. Takes a minute for it to come up. Do you guys have this problem too, or is it just me? Just slow. So is the weather bad up there in Anoka?
I
It's still
haven't been
kind of
out.
rain and ice.
What?
Sorry, I was gonna say I haven't been out, but it doesn't look too bad out my window.
Really? Oh, it was bad down here. Who else
Oh.
was going to say something?
Oh, I just said it's still kind of raining and icing up here.
Yeah. Guys, when I saw the forecast, I just kept thinking it would go away. And then finally I thought, I just don't even want to mess with nasty weather. Excuse me. I didn't want to mess with any nasty weather today. It was very icy here. Okay. I got this up. So let's look at a problem. So let's go to number 8. Now, this one wants us to find the present value of these various payments. So it says here, on September 1st, 2024, a company decides to lease office space in a building. The building's owner offers the company the following options, with the first monthly payment beginning on September 30th, 2024. it says, sign a 2-year lease with monthly payments of $3,000, or sign a 3-year lease with monthly payments of $2,750, or sign a 4-year lease with monthly payments of $2,500. For each option, calculate the present value of the lease payments using an interest rate of 6%. Then we'll record the leases and which option is for the highest amount. So in order to figure this out, we're going to go to Excel. And we are going to go up here. Let me get rid of these. Where we take the lease is for 2 years. So I'm going to show formulas, financial formulas, go down to present value. And we're going to show the rate is at 6% over 12 months. See how I did 0.06 divided by 12. The number of periods is 24 periods. It's 2 years. The payment is $3,000. The present value of 24 months of $3,000 payments at a 6% rate is $67,688. So $67,688 would be the present value of the first option. The second option is for a 3-year lease with monthly payments of $2,750. So we would go and we would take financial present value, and the rate is 0.06. Divide that by 12. Number of periods, is it 3 years or a 3-year lease, $2,750. So the number of periods is 36. Payment is $2,750. And we see here the present value of those 3-year lease payments at a 6% rate, $2,750 per month, is $90,395. Then it asks, sign a 4-year lease with monthly payments of $2,500. In that case, financial present value, the rate is 0.06 divided by 12 for 12 months, 48 months, payment of $2,500. That present value of 4 years of payments at $2,500 is $106,000. So the more desirable one would be the $67,688. That is the cheapest. Okay. Does that make sense? Any questions on that? So you would fill in those numbers, then record each lease on September 1st, 2024. Each of these would show the same. We would show a lease asset of the 67,000, let me just, 67,688.60, 67,688.60, and the lease payable would also be 67,689. You're going to do that for each one of those various payments. Okay. Then, which one has the highest lease payable? It was the third option, had the highest. We would want the lowest if we are the one paying the lease. Any questions on that before I move on? Next. Then we want to look at bonds. On January 1st, 2024, Twister Enterprises, a manufacturer of a variety of transportable spin rides, issues 600,000 of 8% bonds due in 20 years, with interest payable semi-annually on June 30th and December 31st of each year. So one thing we know, 600,000 is the face amount. 8% bonds is the stated rate. The payment amount will be 600,000 times 8% times half a year, or 600,000 times 4%, which would be $24,000. If the market interest rate is 8%, the bonds will issue at 600,000. Record the bond issue on January 1st, 2024, and the first two semi-annual payments. So what they're telling you is these bonds are issuing at the face amount. Stated rate is the same as the market rate. Therefore, the debit will be cash of 600,000. The credit will be bonds payable of 600,000. Then, when a bond is issued at the face amount, we don't have a premium or a discount. So the entire payment goes for interest. We will show that interest expense, 24,000, cash, 24,000. And that will be the same journal entry for the second interest payment. Does that make sense, guys? Yes, no?
Yep.
Yep.
Can you just go back one to the number 2? I didn't catch that.
I don't know what you have to be more clear. Go back to
The number 2 on question 13.
the number 2, this
Yeah.
one here. So
Yes.
all I'm doing is showing the interest expense. Since these bonds were issued at face amount, so that means the bonds are at 600,000. We know that the payment is going to be the issue or the face value of the bonds times half the stated rate, which is 24,000. The interest expense will also be 24,000 because if you take the bond of 600,000 times the market rate of 4% for a period, it's also 24,000 too. So the interest expense and the cash, the payment, is identical in this example. That's easy when bonds are issued at face amount. Now this one gets a little trickier. It's our same scenario. Bonds are face amount is 600,000, stated rate is 8%. Bonds are due in 20 years. And it's telling us here if the market interest rate is 9%, and it tells us the bonds are going to issue at 544,795. So let's look at this. If we start this 544,795, let me get rid of all this. So what do we know? We know the carrying balance is 544,795. We know the face amount of the bonds is going to be 600,000. We know the payment is 24,000 every period. This interest rate is 9% annually or 4.5% each period. So we'll figure, because that's the market rate, the way we figure the interest is we take the carrying balance of the bonds times 4.5%. And we get 24,515.78 is the interest. Do you see the amount of interest is greater than the payment that's going to be received? So the difference, the 24,515 minus the payment, that extra is 515.77. That discount needs to be added to the carrying balance of the loan. So after that first payment, the carrying balance is now 545,310.78. Now, to do the next payment, we're going to take the new carrying balance times 0.045%. Do you see how our interest is increasing each period? So in this case, the interest is at 24,538.98. The difference between the interest expense and the payment is 538.98. We need to add this to the carrying balance of the loan. And we now have a new carrying balance, 545,849. So no, the payment remains consistent. The payment is a result of the face amount of the bonds times the stated rate divided by 2. And the reason we divide it by 2 is because there are 2 payments in a year. So we calculate the payment amount because it happens twice a year. The interest is going to be calculated by the carrying balance times the market rate divided by 2. The reason we divide that by 2 is we want to come up with the interest for the period only. And since there are 2 periods in a year, we're going to divide that by 2, because remember, the market rate is always figured out in terms of the annual interest rate. The discount is going to be the difference between the interest expense and the payment. And the carrying balance continues to increase until it finally hits at 600,000. Remember, the reason the bond was issued at a discount because the market rate was greater than the stated rate. The way in which we will show the payment or the journal entry in this scenario is this first line. The payment is always 24,000. The interest expense is 24,515.78. And the discount is, I'm off here with my numbers a little. $515.78. Let me just see what I'm doing wrong. Here, let me just see what I'm doing wrong. If I equal this times 0.045. Equal this minus this. I think I need my. Okay, so in this scenario, this needs to be over here, sorry. 515.77. So our interest expense is the 24,515.78. Our discount on bonds is going to be a credit here of 515.78, and our cash is 24,000. The second recording for a payment will also show interest expense. Now to be 24,492.57. The discount on bonds payable is 492.57. And our cash is 24,000. That makes sense. Let's try the third line. I want you guys to attempt it. Attempt the third one and tell me what you come up with. Anyone? Anyone? I'm waiting for someone to help. Should I call on someone? That wouldn't be very nice, would it? Anyone? Okay. Moving on, if no one can do that. Now, the next one is going to be when the bonds are issued for a premium. This case, it says it's the same information. The face amount is 600,000. The market, the stated rate is 8%, but the market rate is 7%. It's telling us the bonds will issue at 664,065. So what we'll do here is show 664,065. And in this case, this figure is 7% or 3.5% every period. Okay. So the numbers are going to interest rates are going to be at 3.5% each period. So we take the 664,065 times 3.5% to give us 23,242. As you see here, the difference between the interest over the payment is a reduction of $757.72. This is a premium, meaning that the payment is greater than the interest we're receiving, or the interest calculation. Therefore, that difference will go to reduce the carrying value of the bonds. So you see, we started at 664,065, and then after one payment, our carrying value of the bond went down by $757.72. So for the next period, our interest will be calculated on a carrying balance of 663,307 times 3.5%. That gives us 23,215.75. We take the difference between the payment and the interest, and we see it's 784.25. We reduce the carrying balance by that amount. The next one, the carrying balance times 0.035. The difference will reduce the carrying balance. Nope, did that the wrong way. Do you see it continues to go down, and it will continue to go down until we're at 600,000. So on this scenario, we've got premiums on the bond payable. So in this scenario, the interest expense is 23,242. The premium on the bond payable that we will debit is 757.72, and the cash is 24,000. The second time will show premium on the bond payable. Interest expense here is 23,215.75. The premium is 784.25, and the cash is 24,000. Does that make sense how we do that, guys?
Yep, I
Question?
understand that one.
What?
I said, yep, I understand that one.
Good. Anyone else have questions, guys? Okay. Now we're going to go back to the PowerPoint. And we're going to talk about retiring bonds. Now, when bonds are retired at maturity, it's pretty easy. When they retire at maturity, the bonds are at the face amount. And so when a $100,000 bond retires at maturity, all we do is debit the bonds payable and credit our cash. There's no gain, there's no loss. It's nice and smooth. However, when bonds retire before maturity, we're going to have a gain or a loss on bonds. In this example, California Coasters issued bonds on January 1st, 2018, above the face amount at a premium. So in this case, $107,439. The carrying value of the bonds 1 year later, on December 31st, 2018, is $106,877. We're showing that the bonds retired before maturity when the bonds had a carrying value of $106,877, and they retired for $114,353. So the cash that was paid out is the $114,353. We need to show exactly where the bonds are at. If they say $106,877, we need to debit the bonds payable of the face amount. We need to debit the remaining balance of the premium on bonds payable, which would be the difference between the face amount and what the carrying value is, the $68.77. We know the cash we had to pay out. So in this case, we have a loss of $7,476 on retiring these bonds. No gain or loss gets recorded on bonds retired at maturity. But for bonds retired before maturity, we record a gain or loss on the early extinguishment equal to the difference between the price paid to repurchase the bonds and the bonds carrying value. Who wants to take this one? A company retires a 50 million bond issue before maturity when the carrying value is 48 million and the market value is 54 million. The company will record what?
Is it B?
No, it's A. We have to pay them what the market value is. So the cash that goes out is going to be 54 million. The carrying value on those bonds right now is 48 million. So because we have to pay 6 million more to retire those bonds, we've got a loss. Okay. Now, this one, it's just like I was doing earlier, creating an amortization schedule. It says here, Splash City issues $500,000 of 9% bonds due in 20 years with interest payable semi-annually on June 30th and December 31st. The market interest rate on the issue date is 10%, and the bonds issued at 457,102, which means it's at a discount. Using an amortization schedule, show that the bonds have a carrying value of 458,633 on December 31st, 2019. So basically, you can see here that if you just keep carrying down the amortization schedule, and you know what the cash is, you calculate the interest expense, you show the increase in the carrying value, you'll end up getting to that carrying value on December 31st, 2019. Okay. Any questions? Okay. Oops. Then to record these, in this case, it says, if the market interest rate drops to 7% on December 31st, 2019, it will cost $601,452 to retire the bonds. Record the retirement of the bonds on December 31st, 2019. So we know what we have to pay, the $601,452. That's our cash. We have to figure out exactly on that date where the bonds were at, which was the 458,633. So we have to, zero out the bonds, zero out the discount. And by retiring those bonds, we would have a loss here of $142,819. Remember, you go and you look at the carrying value of the bonds. Since they were 458,633, that would be the bonds of 500, and we've got a discount of 41,367. That difference there will give you the carrying value of the bonds. Okay. Now, the next portion of this chapter deals with ratios. You guys can go through that. The last chapter in this book, we will cover all these ratios in depth. So go through those, and you've got it for this chapter. Now, I wanted to split it in two because there's a lot to cover here. I hope that was helpful. Any questions at all?